welcome to our first quarter market review. And it was a great quarter. We saw US equities march higher, hitting 10% for the Russell 3000 over the quarter. So a great start to the year by US equities, but in risk assets across the board. And it's really continued to be driven by growth stocks. Over the last year, going back a year, we've seen growth now outperform value by over 1,800 basis points. So a pretty impressive run. We talked a lot about the Magnificent Seven that drove returns last year. Some of those names still driving growth in the first quarter, but some of those Magnificent Seven, I believe, today were the new name is the Fabulous Four. Some of those companies did not perform as well over this quarter, but still growth stocks leading the way for the quarter, and in fact, really over the last year or longer. But risk assets in general outperformed. International equities not as high, but rose 4.7% over the quarter and now for the year. So still some good performance that we're seeing internationally, but less than half of that in the U.S. equity markets, which are still the darlings in the risk asset space. Fixed income, we saw down slightly. Rates, really up and down, but a slight tick up, producing a negative return over the quarter, now year, at negative 0.8% return. And that's in an environment where the Fed held interest rates steady, the Fed funds rate steady over the quarter. And we're starting to see rate expectations in terms of lower rates or a decrease now, those expectations being scaled back. And so I think that's what's causing some concerns in the market with regards to rates and if they may be at this higher level now for longer. And in fact, that's why now we're seeing rates tick higher, because maybe that expectation of a rate cut as soon as June, which now at the beginning of the second quarter, does not look like it's going to happen. The odds are very, very low, I believe under maybe 20 or 10% at this point. The other metric that the Fed looks at when they are deciding rates are the labor market, and that continued to remain tight over the quarter at 3.8% in March. So that's a summary of the market performance in those three broad asset classes. Let's look at some of the detail now in the U.S. equity markets. I really commented on this already at growth stocks continuing to lead the way versus value. And you can see that in the top right-hand chart with the orange bar hiking, higher in last year, 2023, and now this year, representing growth outperforming value. And really you can also see that in some of the growth sectors. If you look at the lower bar chart, and what's outperformed over the quarter and in 1 year period in terms of those growthier sectors outperforming, of course, led the way by, again, last year, the Magnificent Seven. This year, before the stocks that have been called the Fabulous Four. So that's really U.S. equities, which I commented on. If we go to international equities, what we're seeing in this space is growth as well, really leading the way more recently. Over the latest 1 year period, though, it's interesting. It's been the large value stocks that have performed the best at over 18% versus 13% for large developed growth stocks. But now, over this latest quarter, it looks like some of the more growthier names internationally now are starting to lead the way. Developed markets are still continuing to outperform their emerging counterparts. That's reflected in the top right-hand chart, developed versus emerging, where that orange is representing developed outperforming. And as we've seen, and as I commented on, the U.S. equity markets have really been the darlings in terms of generating the performance that they've been able to generate, the growth that's come out of the U.S. equity market. And really, if you look at the lower chart, when you look at international versus domestic, international equities really have not come close to outperforming or even being on par with U.S. equity markets. That said, they still continue to be a decent diversifier in terms of their correlations. And so it is good to have some exposure to international equities in your portfolio. And then let's finish it up with a slightly more detailed look at the fixed income markets. And let's just looking at the top right-hand chart in the yield curve. This is the most interesting chart to look at, which shows the curve where we were a year ago versus where we are today, which is represented by that orange bar. And the curve essentially is the same in terms of slope, slightly inverted from where we were last year to today, but rates in general have slightly increased, and that's put pressure certainly on fixed income. As yields go up, their total return comes down. That's what we saw in the first quarter here, and what we've seen over the last year is pressure on rates, and certainly that may change as the Fed looks to potentially lower rates. Really, now that's been pushed back to really later in the year. But a neat chart to continue to look at to see where rates are. And again, the curve continues to remain inverted. And sometimes that is a predictor of recession, not necessarily a predictor of recession. I think the yield curve has got 10 out of the last 6 recessions called correctly. So it is not always an indicator. So that's a deep dive into those 3 asset classes. I like to quickly touch on market leadership and where we are, and the story is the same. I mentioned this earlier, year to date with large cap growth away, which is really similar to the story that we witnessed in 2023 and as of last year. The worst performing asset class year to date is global REITs at a negative 0.9 versus commodities. Slightly better performance out of commodities. Again, those are more alternative asset classes. Good to have some exposure in some of the multi-asset strategies available to participants through target date funds, for example, not necessarily dedicated options. The worst performing core asset class for the year, fixed income, as we mentioned, at a negative 0.8%. So good to be diversified. If you're a participant, certainly taking advantage of a target date fund makes the most sense for that group. Looking at our chart of the quarter, inflation really is, and rates, really the topic du jour, de quarter, whatever you want to call it. And thought it would be good to look at where we are today versus historical. And this is a great chart that shows the 50-year average. And a lot of folks are saying that inflation is still relatively high and maybe that the Fed hasn't done enough. It's interesting when you look at where we are versus a 50-year average that our current both core and headline CPI rates are below our 50-year average. Certainly we know the Fed has a 2% target, and that's it's been a low target historically. I know people are thinking that, and even there's conversation around maybe the Fed increasing that target to 2.5 or 3. But where rates are today are lower than where we have been historically over, again, that 50 years. And certainly with any inflation spike, when you look historically at experience, typically after an inflationary spike, you've seen, of course, with the Fed's actions in there as well, we've typically experienced recessions. I know a lot of folks have predicted recession. This was even, as of last year and now this year, and now it's being pushed back to maybe at the end of the year, and why the Fed would lower rates, but it hasn't happened. And when the Fed can get inflation under control, bring it down with tighter monetary policy, while the economy is still continuing to grow with positive GDP growth, that is typically referred to as a soft landing, and that's the spot we're in. The Fed is, and what we've heard is engineering a soft landing. Now, certainly that could change. Do rates go higher? Do they have inflation under control? Is this maybe like a touch and go? Have we landed? Maybe, but we're really getting close, or right at that soft landing part, where again, inflation now looks like it's getting under control or close. And, we are really nowhere near right now a recessionary type of environment for the US economy. So good news on that front. That is it for our first quarter market review, and we will see everyone next time. Thank you.